Closer Show. As always, Scott Carson, excited to be here today. Today, I want to talk a little bit, probably something that you guys have seen in the news. It's all the distress with these different banks. And people are asking me, hey, are we going to see a lot of residential notes on these banks that are going out of business? Or what's the deal with these banks that are failing or struggling, or these things that are popping up? And I kind of want to clear a couple of things. There's really kind of two. When we think about buying notes, most people constantly think directly to the residential side of real estate. And that's great. That's where a lot of us are spending their time, on where a lot of people are making their money. I had somebody reach out today, hey, I want to buy in LA, or I want to buy in Minnesota. And I'm like, that's great. But the banks that are making the headlines aren't necessarily your big lenders like the Bank of America's, the Chases, the Cities. They're not big residential mortgage originators. They don't hold a lot of residential debt on their books. They're more on the commercial side of real estate. And I saw an article on LinkedIn that explained it better than I've seen anywhere else, in very layman's terms, about what's going on with the market when it comes to commercial real estate. And while the residential housing market is still strong, we still have a very low distress rate or default rate out there. You're still going to have defaults. And when you have 80 million homes and you get a 2 to 3% default rate, that's still around 1.6 to 2.4, somewhere around 2 million homes are in default. That's not counting owner finance stuff and other people that are distressed for a variety of reasons and stuff like that, bankruptcies and things. But I'm not going to talk about the residential markets today. I just want to say the commercial market is completely different. Now, especially with what's going on now compared to 2008. Now, we're not going to see a huge, like 15 million homes in default or underwater like we saw back in 2000. I do think that we will see an increase because of a couple dominoes falling, and I'll get to that in a minute, why that is. But on the commercial real estate side, what's happened in the past few years that is leading to these delinquencies, leading to these banks that are struggling, comes from the fact that this time around, after the Great Recession, where Wall Street financed it, and Lehman Brothers was the biggest bank failure out there, big investment bank, stuff like that, you had a lot of regional banks that got into the originating commercial real estate loans, okay? And commercial real estate loans are a little bit different than a residential loan. A residential loan, you got banks financing, lenders financing that, for a primary residence, 90, 95, 100%, plus closing costs or some stuff like that. They're very risky. If it's government backed, they've got some government insurance. Now, with the commercial real estate, they don't have that insurance by the government side of things. So this is why in a commercial loan, investors, or borrowers, I should say more so, borrowers are having to bring 25, 30, 35% down payment of some sort, so that a bank, which most of the commercial debt's been financed the last 10 years, has been financed by your medium to larger banks out there, much more than it was back in 2008, 9, and 10, or before the Great Recession. So you had a lot of these banks that were financing stuff at 65, 70, 75, even 80 cents on the dollar, because market was running strong, interest rates were low. That's a great thing. But when interest rates start to change, it really changes the relationship with the bank. And then you throw in COVID. You throw in deficiencies, delinquencies, people not paying their rent, people then not paying their mortgage because they're not getting rent from their tenants. It leads to a domino effect, especially when you have the Fed start increasing interest rates, and it makes things a little bit different. So there's this great article written by Casey Conway. He is the principal and co-founder at Red Shoe Economics. And he had a post here in response to somebody. He says, it's not that complicated where we're at in commercial. Commercial real estate is capital intensive and thrives or dies on debt, okay? Nobody's on 100% financing or bringing cash in a commercial real estate space. It's finance. You got to have good financing terms. You've got to have mortgage on this stuff. When interest rates go up, so do cap rates. Now, as an investor, I want to buy on a high cap rate, but I want to sell on a low cap rate. A higher cap rate basically has an inverse relationship of a stock. It's inverse of a stock multiple used to convert NOI into a value to calculate net operating income. Because basically you take your net operating income divided by the cap rate to figure out the value of a property. And the higher the cap rate, the lower the value. And that means that commercial real estate values drop. Okay. Especially when your NOI goes down, your profits are going to go down. It's definitely going up. And banks don't like lending on assets declining in value. Now, one of the things that people have kind of failed to see, and this is both residential and the commercial side, is, oh, they're always like, the market's going up, it's going to keep going up, values and keep going up. That's great, but what happens when the values start to drop? Well, a bank, commercial bank that's doing a commercial loan, like I said, they don't want to be really above 70, 75% of the value. Well, if your NOI drops, your cap rate drops, and your values drop, guess what? They're no longer at 70 cents on the dollar. They're now at 80, 85 cents on the dollar. Okay. And banks don't like lending on declining assets. Okay. In the equation, you add into the equation that expenses are growing 2 to 3 times faster than rent growth. Cost of goods, cost to repair, cost to build out, cost to rehab, and NOI and values decline even more when you start adding those extra expenses to it. Okay. It also takes longer for the owner to recoup those rehab expenses or these build out expenses too. Then you look across asset types and you start seeing things that get hit even harder, like office space has been hit the hardest. And one of the biggest things for that is like what we saw happen with COVID. Remote work will do to office building values what e-commerce did to big box retail and malls. That's why you can buy literally, you are seeing 50% of malls or more across America in disarray, vacant, in default. Simon Malls, one of the biggest holders of mall space, is really struggling. If I would do anything, I'd short that stock all day long, even though it's been hit hard. Okay. And then also you add a little bit of extra magic to it. The Fed actually came in and broke the economy and commercial real estate assets values by failing to understand how the steepest rise in interest rates decimated all assets with a fixed rate. If you got a fixed rate, you can plan. But if you got a little bit of an increase, like I'll give you an example, like a T-bond, municipal bond, a GSE mortgage, or any commercial real estate loan with maturity risk. And what does that mean? Well, if you've got a loan, it's a 4-year, 5-year, matures in 5 years, and you've got rates that are going up, and you're trying to refinance that loan, now your costs are more. They're double, triple in interest rate. You could get a 2-3 year, just simple, 3-4% interest rate. Well, now it's at 6 or 8. That reduces your profitability, which reduces your in-net operating. It also makes it harder to get qualified. Okay. So it's really that simple, but it is very hard to fix, And it's, as Casey likes to say, he's like, congrats, Fed, you broke the economy. Now go look at the Texas ratio to see how many banks are at risk of collapse. Now I'll talk about the Texas ratio in a second. And it's the commercial real estate concentrated banks, and the number is in the hundreds of banks that are struggling and facing a risk of collapse. Now, what is the Texas ratio? And the Texas ratio, if you define it, if you go out and Google, it's pretty simple. It's the Texas ratio. First of all, it was developed to warn of credit problems at particular banks or banks in particular regions. We call it the Texas ratio because the Texas Savings and Loan Scheme back in the 80s or in the Resolution Trust Corporation in a lot of cases. Okay. It's a system to identify credit problems at banks that's calculated by dividing a bank's non-performing assets, okay, by the sum of its tangible common equity and loan loss reserves, okay? And so when you have a ratio of more than 100% or 1-to-1, okay, means they have more non-performing assets than what the resources the banks have. It means the bank may need to cover potential losses on those assets, which is not a really great place a bank does not want to be. So that, okay. Let me give you an example here. Yeah, during the 1980s, Texas saw an energy boom. Banks financed a surge, but soon the oil surge died down and banks started to struggle. As a result, Texas saw the greatest number of bank failures from 1986 to 1992 in the nation. That's why it's called the Texas ratio. And so, give you a bit of it. As part of the Texas ratio, non-performing assets, including loans that are in default or real estate, the bank has had to foreclose on, which REOs, real estate owned, it's not an income generating asset. those could become expenses for the bank. On the other side, tangible equity does not include intangible assets that cannot be used to cover losses, such as goodwill. Okay, so that's the thing I realize. It's the Texas ratio is very useful for investors as well as customers. Banking customers will access the Texas ratio to ensure their money is safe, making sure that, hey, if I put out $1 in, I'm gonna get $1 back. Oh no, I mean, if I put $100 $1 in, I'm gonna get 80 cents back because your ratios are way out, like negative inflation. You've heard that talked about in the past as well. All right. Texas ratio is best utilized when utilized with other analysts of the actual bank. A high ratio doesn't mean the bank will go bankrupt, as many banks can operate with high Texas ratio as long as there's not like a run of the bank or there's a huge amount of defaults. Now, the fact that the Biden administration allowed for banks, reduced the need to keep a lot of deposits in there, that's put things at risk. They haven't gone back. It may have been Trump back during COVID. It may have been Trump that allowed to do it, maybe not just Biden. They allowed banks to run without a lot of reserves. That has not been reinstigated where the banks need to go back in and put money back into reserves and stuff because, hey, stuff going on. So that's the problem right now. That's why you see a lot of these banks are kind of on that cusp of distress because they have a lot of commercial debt that's clogging their books. And you have a lot of banks that are commercial banks, not your traditional Chase, Wells Fargo, Bank of America. I mean, there's give you an example. There's over 5,000 lending institutions. And if you look in Bauer Financial or the FDIC.gov, you can run some reports and see that there's roughly about 1,500 lending institutions out there, banks that qualify themselves as banks that have at least 5 branches or more. And by 5 branches or more, this is what we look at for non-performing residential debt, is that they start having a little bit bigger of a footprint, so they start being a little bit more aggressive in their lending and doing more residential loans versus being very careful about it. Now, the same thing goes with commercial loans. And I'll tell you right now, as an ex-banker, that was one thing that they wanted us to do as a banker, especially for JP Morgan Chase or Bank One before Bank One was acquired by Chase, was commercial loans, because the assets are there. The assets are there in an increasing market. Great. Well, I'll give you an example. Back in 2008, when we saw the shit hit the fan, Chase didn't do one single commercial loan in the state of Texas for over 2 years. No line of credit, no commercial purchase. They didn't do anything in Texas. Now, are we going to see that again? I don't know. But I'll tell you this. There are a lot of bankers out there, and there's a lot of commercial investors. And this is something to keep an eye out for, too, because we've had so many people reach out. I'm an apartment investor, I'm buying a commercial property. It's distressed. I'm going to regentrify it, rehab it, get the rents up and running. And then in 3 years or 4 years, we're going to refinance that property, pay off all our investors and keep the profits on this stuff. That exit strategy is not really viable in a lot of cases. So it'll depend on an asset by asset basis, what's going on with the asset, what's going on in that specific market, where they're at. But I'll tell you that there's some opportunities out there because there's a lot of banks that are going to be calling for investors, especially if the numbers are where they're at. Like, oh, we're not going to refinance you because the interest rate is now 2-3 points higher. You need to bring in an additional 10, 15, 20% cash to the table. So don't be surprised if you're part of a syndication in an apartment complex or something like that. If the sponsor starts reaching out to the investors, say, hey, we need to do a capital call. We need you to bring some more capital to the table so that we can refinance. Well, if you bring more capital to the table, but you're in a lesser valued asset, what's that mean? It means your investment is diluted and your value of investment is less. Your ROI obviously goes down if you put more in and getting less out of it. So keep that in mind. Doesn't mean there won't be great opportunities in commercial debt. There's a lot of smaller banks, a lot of regional banks too, looking to divest in this commercial space. But the couple of the asset classes I would definitely stay away from right now is that office space and that like strip mall, retail space for sure is difficult. Unless, of course, you have a play that you're wanting to run with that. I've seen people take big box stores and convert them to self-storage facilities. We've seen some other malls be converted to apartment complexes or other types of, self-storage or other things that they could use if the bones of that establishment, the bones of that asset allows for it. Of course, if you've got to recode or rezone a property, you got to go through the city to figure out what they do. What's that process for getting a property rezoned so that it can be used for different, different type of asset or different type of use by the city. So it all vary definitely. Like I said, city by city, bank by bank, it's going to be different. But one of the things you can see if one of the lists that we do pull is the Bauer financial list, which is basically just a spreadsheet with all the FDIC reports for, like I said, banks over 5 branches that we purchase every quarter. And yes, there are hundreds of banks with a high Texas ratio, and that number has gotten higher when you look over quarter after quarter after quarter. And that's necessarily not something you want to see, but it is just what it is. And with every quarter point that the interest rates go up, you get commercial debt, it gets tightened down, and that value starts to decrease, and it's going to affect more things. Because if you're trying to refinance, you want to have equity, not have now equity below the LTV or the combined loan to value, especially if you can do a seller carryback of some sort. You're going to have to be interested. This is where I do believe we'll see a lot of, if you're buying on commercial, it may be best to ask for terms or owner financing in a lot of cases for a period of time. I was actually just working with a student of mine who's out of Minnesota. He's looking at buying an apartment complex. I said, well, is there debt on it that you can assume it's really great long-term debt? Are the rates better on that loan? Is it a longer term than going out and trying to qualify for a new loan or bring all cash to the table? Maybe you can get away with just bringing 10% down versus the whole 100% the purchase price. Now, it's not the biggest purchase price. I think it's 650, 700, something like that. But he hadn't even considered that. And I said, take a look at that, because that's an opportunity for you out there. So keep in mind, once again, big thanks for Casey Conway for sharing that description. Just an absolutely great. But there's a lot of credit and liquidity that's leaving the market. When you have that happen, asset values fall, banks get tighter, and hopefully we don't see a lot of banks go out of business. But if we do, you just got to know where to play. So definitely important to have cash in the sidelines so that we're ready to rock and roll when things are available for you. And when everybody's running one way, run the opposite way is what Warren Buffett would say. So go out, take some action. Hopefully this was helpful for you. A quick explanation kind of where things are at. Commercial real estate's different than residential real estate. All right. The sky's not necessarily falling on the residential side. We've had some correction. Okay. But it is getting nasty and gray clouds out there in the commercial real estate space. So go out, take some action, everybody, and we'll see you all at the top.